Welcome to Nasdaq Trade Talks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, as well as Dan Deming, Managing Partner at KKM Financial. We're here to discuss how the options market is responding to the Trump administration's initiatives and spending bill. It is great to have the both of you with us, as always. Dan, it's interesting. The markets appear to be adjusting to the increased news flow that the administration has put out, certainly, over the course of the past week with the passing of the OBBBB.
Right. Yeah, Jill, it is impressive, honestly, that, there's still a great deal of uncertainty, but the market seems to be getting to a point where it feels like the pricing structure is within the construct of the impact of the uncertainty. And, it's the evolution of just how markets work. I mean, Russell and I have been through this many times over the years, and you see the markets have hit something new, like the tariffs that we did see and all that early, in the year, which really caused a significant disruption. But as the impact begins to be understood and then the understanding of how it can influence the market on a day-over-day basis, we are seeing that, continually work its way out of the market, and the VIX continuing to move to the lower end of the range going back to February as, again, volatility has come in. And now, as we've experienced over the last month, significant upside momentum, and that's another factor contributing to, I think, the reduced vol measures as we ended June going into July.
Yeah, and Russell, one could argue too that in the month of June, really in the absence of earnings and anything as it relates to the corporate calendar, markets are especially focused on headlines, macro, and what's coming out of the administration. But you're also looking at a different risk indicator, the 1 day at the money straddle, which is helping to identify how the market could be digesting all these headlines.
Yeah, I'm a gigantic fan of VIX and kind of made a career out of talking about it. But I think for certain risk measures, that the one-day straddle on an index like the NDX, which varies tremendously over time. There's almost a 3% range between the low end and the high end of what's been priced in for the next day, Monday move. I feel like that's a risk indicator where we've got 4.5 years of consistent daily data so we can start using that data. We can have headline risk, etc. And a lot of questions what's going to happen rate-wise. This straddle was priced at the lowest level on average on the June for the full year of 2025. Which is kind of surprising. We're not really seeing those in the volatility indices that are matching up with that. And we also saw missed average pricing for at the money index straddles, 1 day at the money straddles at just under 2% on average. Back in April, which should not be a big shock because that's when when the tariff announcement came out, there was a lot of uncertainty with respect to the equity markets. But just completely we have reverted to relatively low levels it's really surprising, but it definitely does not mean we're out of the woods yet. And I know Dan's going to address that with respect to the VIX curve. I don't want to step on his toes here.
Yeah, well, Dan, let's talk about that. Also, what you're seeing in the futures curve as well. That's indicating that the volatility markets are digesting the news and everything that comes at it in a relatively I wouldn't say complacent, but certainly more calm than I think perhaps market participants had expected.
Well, yeah, I would say, again, it's the realized vol component that's really impacting the pricing structure. As you look at the VIX, we're seeing realized vol continuing to trend lower, pulling the VIX cash lower. But when you compare it to last summer, we're still well above last summer's levels, but at the low end of the range for this year. But what is interesting, as Russell was talking about, the short end of the VIX construct or the volatility construct, is coming in quite a bit because the day-over-day price action isn't significant enough to realize the moves, and therefore we're seeing a lot of action on short-dated options activity around volatility metrics. But if you move out on the curve, again, we're looking at the term structure of the futures curve, in this case, when the CBOE VIX futures, You're seeing that front month future getting dragged down late in the cycle, but as you move out on the cycle, the premium level is still holding significantly with most of the futures above 20, even though we're seeing realized volatility hovering around 10. So therefore, it implies that the short-dated uncertainty continues to be pulled lower, but when you look at it out at 60 days to 90 days or further, there's still a significant amount of uncertainty priced in, given the fact that over the course of the next several months, there could be something that would impact the market and have a significant impact on the options market as well.
Dan, do you think the short-term options are getting more activity, if you will, because there's just more of them that's available? Perhaps if you're looking at it apples to apples from a historical context, there's just more product that's available to, express these shorter-term or longer-term concerns in a more discernible way.
Absolutely. Absolutely. I mean, the evolution of zero-day options and 1 week, even the weeklies that came on several years ago, that had an impact as far as the overall pricing structure in the options market, because liquidity does create efficiency. And, so that's another factor that's contributing to, I think, as you continue to see the evolution of the options market and more participants having access to the pricing structure, the real-time data feeds, and all the other things that technology has issued over the last several years. It's certainly created more efficiency in the pricing structure, more opportunities for market participants. And I think that overall is providing the liquidity that helps keep these markets fairly efficient and pulls in some of these metrics that have been a little bit bigger or wider over the previous history of option pricing, due to the fact that, again, we're seeing the term structure and the term, I should say, of the options activity being pulled tighter and tighter and tighter with more liquidity.
All right. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.